Hello everyone, how are y'all doing? Today I'm going to be introducing the world of investing, specifically stocks. Everyone's told you to invest at one point, but if you don't know where to start, this is the perfect video. So before we can get into stocks, there's something you should know. It's something called inflation. Inflation is something that happens all the time. It's when money becomes less valuable. A cup of coffee cost 25 cents in the 1980s, and now it costs around 7 times that. It's not the coffee that's becoming more valuable, although that definitely does play a role. It's the dollar that's losing worth. And as the dollar is losing worth, you need more money, more dollars, to buy something as simple as a cup of coffee. Well, why does this happen? Well, inflation happens when governments print more money, and as there's more money, the value of a dollar becomes less valuable. And this poses the question, what does inflation have to do with investing? Well, when you have a net salary of say $50,000 and you withdraw all of your money in cash and store it in your home, with each passing year, as more money is printed, your money becomes less valuable, so by just letting your money stay in your home collecting dust, you're actually losing money. What about storing your money in a bank like everyone else? Well, when you put your money in a bank, the money is compounding at a rate of less than 1%. And with inflation rates of like 6.4% this year, there's no way you're not going to lose money. So what do you do to beat inflation? Well, you gotta invest. Anything from buying a piece of chocolate and selling the piece of chocolate for more. For this video though, when referring to investing, I'm talking about stocks. So what's a stock? Well, a stock is buying a piece of a company. Companies can divide their ownership amongst multiple people, and each piece of ownership is referred to as a share. So for example, if I own a company that sells pears and I divide the company into 100 parts, those 100 parts are otherwise known as 100 shares. And let's say 100 random people buy those 100 shares of my company. Well, then they all own 1% of my company. Now with the same example, what if 49 people bought 49 shares of my company's stock, and there's one person that bought 51 shares, so 50 people in total? Well, then that one person would own 51% of my company, and the rest of the shareholders would only own 1%. And with the ownership of my company, as it grows, the shareholders would have more valuable stocks, so more money, and if my company shrinks, the shareholders will have less valuable stocks, so they'd have much less money. And with that guy who bought the 51 shares, with more shares of the stock, you'd be much richer and much poorer than everyone else, depending on how many more shares you had. And so, if my company ever dwindles, that guy with the 51% of shares would be way poor. He'd lose way more money. And let's go back to the pear example. Let's say around year 0, when my first company started, right? It had, for example, a share that costs $10. So each share costs $10. And let's say 5 years later, each share costs $3. So my company devalued, it shrunk. And let's say then around at year 10, my company's share was worth $20. Well, if you originally bought a single share for $10 when the company first started and sold it 10 years later for $20, well, you made $10 in profit. Anyway, the moral of the story is that you don't actually lose money until you decide to sell the actual stock. Similarly, you don't gain money until you sell your stock. Just having the stock, essentially, doesn't mean you have the money. You gotta sell that stock to someone else first. And this introduces diversification. It's where you spread your investments amongst multiple different companies, so if a single company underperforms, you won't be in as much trouble as just investing into a company and just seeing it fail. A perfect example of diversification is buying index funds. Well, index funds in specific almost have a 100% guarantee that you will make a profit in the long term. Index funds are essentially where you buy a stock and the stock is divided amongst multiple companies based on the value of that company. So for example, with the most popular index fund, the S&P 500, which is a stock that includes the 500 biggest companies in the United States, with Apple on top, then Microsoft and Amazon at number 3, with the list going down all the way to some lesser known companies like Pentair or Juniper Networks that I certainly don't know, and if you don't know, well, we're in the same boat, I guess. Anyway, for index funds, a larger portion of the stock will go to companies higher up the list, and a much smaller portion of it will go to the lesser known companies. For the S&P 500, it's like 6% for Apple, 5% for Microsoft, and I think you get the idea. In general, the value of your stocks, are more dependent on the more reliable larger companies than the smaller, lesser known ones. And for these large index funds, it's almost guaranteed that you'll make your money back, because with the 500 biggest companies in the United States, for example, they represent the whole state of the global economy to an extent. And if the index fund, in this case the S&P 500, does badly in the long term, well, so does the US economy. And ultimately, it would usually be met by some government intervention in the form of some law to recover the value of a share in the S&P 500. In this case, if the S&P 500 did ever fall too drastically without any governmental intervention, it would be some almost apocalyptic doomsday scenario where your money wouldn't be much of a concern then. I mean, even if you see this graph with the growth of the S&P 500, it's always been increasing in the long term, but let's say you bought it in December and sold it in February. You would potentially lose money, because in the short term, as you can see, there have been times when the S&P 500 did shrink. But generally speaking, you will make your money back with large popular index funds. Now, for what you've been waiting for. You want to start investing. Well, first off, you can be at any age. If you're under 18, you will need parental assistance, so keep that in mind. But for the most part, investing is for anyone. Now, what if you're like, oh, a share of this stock is too much. It costs $5,000 and I only have $5. Well, you can still buy a share by buying a fraction of one instead. So if you did use your $5 to buy the $5,000 share, you would have what's referred to as a fractional share. So in this case, you would own 0.001 of a single share. Now, how do you actually buy the stock? Well, you first have to go to a broker. A broker is someone that buys the stock for you. Shocking, I know. Today, though, most of the stock buying is done by online brokers from different websites or apps. And since there's so many different requirements for brokers in different countries, they're different from country to country. You know, for the UK, for example, there are different brokers than the United States. And some brokers based in the United States that I would highly suggest are Vanguard, Robinhood, and Fidelity, only to name a few. And it's important when choosing a broker, and when you choose the broker, you have to choose the broker that provides you with the lowest fee percentage. So some brokers, for each transaction, for each share you buy, for each withdrawal you make, they will take a small fee, and these fees certainly add up over time, so you have to be smart about these things. Once you decide on a broker with the lowest fees, it's mostly self-intuition from there. You'll choose a company, or multiple different companies, or an index fund to invest in, whatever you like, and you will see the returns most of the time if you do invest smartly. Now for some investing tips. Before buying any stock, you want to do some research and see what professional investors are saying. Most of the time, investors won't try hiding good investments. Instead, they'll try convincing you, because it's likely that they've already invested in that stock as well. And the more people that do invest in a company increase the likelihood of higher profit margins. In other words, if you invest, you'll probably both have a higher chance of making your money back. Another tip is that when you are buying stocks, buy stocks when companies are at their lows. Going back to the pear example, when the company first started at a share of worth $10, remember at year 5 the company share was worth $3. Well, if someone bought a share for $3 and then when the company was at an all-time low, later on at year 10 he could have sold the $3 share for $20 and he could have had a much higher profit margin, $17, than just buying it at year 0 and selling at year 10. Essentially, you can make the most money from the worst times. Another tip is that when you do invest, especially in index funds with almost guaranteed returns, the best thing that you can do is forget that you ever invested to begin with. By leaving the money alone and not touching it for many years, you're ensuring the maximum amount of growth. And my final tip is that investing ultimately is just a gamble. and this makes it completely vital to have an emergency fund when investing. So if you do put your life savings into a single company and it fails, you won't be completely screwed. You want your emergency fund to have just enough money to make up your living expenses for around 6 months until you can get back onto your feet. Finally, I want to end off this video by saying the best thing you can do after watching it is to start investing. Life is short, and by investing sooner, you're giving yourself the most amount of time to make the most amount of money. Thank you for watching. I hope you enjoyed the video just as much as I did. Please consider subscribing and liking the video. Feel free to comment. I'll try answering as many questions as I can to the best of my knowledge. And I hope I can catch you guys later. See y'all, and I wish you the best in your future investing endeavors. Adios.